We'll just start with a bit of history on Warrawoona. So gold was first discovered here in 1890. It was mined for about 10 or 15 years, shut down when Kalgoorlie was found, and it's sat idle since then. We came along in 2017 through 7 transactions. We consolidated the belt and started drilling. We started with 400,000 ounces, and we've just published an updated resource of 1.5 million ounces. As Paul said, we've updated our pre-fees very recently, and I'll take you through those numbers. And now we're neck deep in the definitive fees, which we aim to get out in this quarter. That should lead on to a final investment decision later this year, construction next year, and all being equal, we could be seeing gold bars being poured late next year. Just briefly on the capital structure and corporate, fairly vanilla structure. I think the important things to note, cash at bank hasn't really changed. You'll see that in the upcoming quarterly. We've had quite a few options exercised in the last month. Major shareholders, Alkane Resources with just under 13%, have been an incredibly supportive shareholder on the journey, and board and management with 8%, mainly through money in, are highly leveraged to share price and is what drives us to make a success of this. The team's coming together, some very good experience from our chair, Mark Connolly, through to our CFO and COO who have joined us, experienced industry veterans, Paul Brennan in particular, most recently GM at Carosue Dam for Saracen Minerals. So we are in the Pilbara. It is hot for gold at the moment. We've obviously had De Grey up there with a fantastic find in recent times, and we're seeing a lot more interest for gold. It is a bit of a forgotten province in WA, but was actually where gold was discovered before Kalgoorlie. Not only that, this is the centre of iron ore mining in Australia, and as such, the mining services industry has a big footprint here. Very rich in infrastructure. We'll be looking at getting LNG from the Northwest Shelf, trucking that down. That keeps our power costs down very low. We're upgrading the Marble Bar Airport. We've signed an MOU with the Shire of East Pilbara, who've been very supportive. They'll put in $5 million. We'll put in $2 million to get that going so we can land jets directly from Perth there. We've bought a village from down at Newman, and we've trucked that up to site, ready for installation. We've signed off with Telstra to fire communications back into Marble Bar. So very easy to get up and running in comparison to some areas, and also at a much lower cost. So with regards to the updated resource, we're around the 1.5 million ounce mark. The grade has dropped slightly from where it was before, and this is really due to a fact of how we've modelled this deposit. As we get closer to the pointy end and actually having to dig this ore out, we've taken a very conservative approach. We've used very big blocks in the modelling, which dilutes the grade and keeps that grade down, but more mimics what we would see with a large excavator. So we're very comfortable with that grade. There is a red box down below the centre of the resource in this slide that you see. That's where we're currently drilling. The resource only goes down about 250 metres, and we're drilling down to about 550 metres, so another 300 metres down. We should have those diamond tails in August and report those results in September. But the idea here is to show that this deposit is open. It's going to be around for a long time once we develop it, the mine, and we're pretty excited about seeing what that drilling turns up. With regard reserves, so we're over 500,000 ounces of reserves now, and this is obviously what forms the base of the definitive feasibility. And the bulk of these reserves are at Klondike, which is our main deposit. And the bulk of them are in a single big open pit, which keeps the operation very simple. And simplicity is a theme that we will come back to quite regularly when we talk about what we're up to, because with that simplicity comes success of development and minimisation of risk. If we look at the reserves a bit here, I think one of the things to look at is strip ratio. This ore does outcrop at surface. And when you look at that and our strip ratios of 3.6 to 1, that's why we can generate a lot of cash, which we'll talk about in the updated pre-fees results. One of the things that we are looking at doing is scheduling the pit so that we stockpile a lower grade ore, the 0.3 to 0.5 gram ore. That allows us to feed a high grade ore for the first 5.5 years of 1.2 to 1.3 grams and keeps our ounce profile up, cost down, and generating superb cash margins. From a metallurgical point of view, this is really about as good as it gets. It's soft rock, it's a coarse grind, it's low power cost. All of that means it's low cost per tonne, but very good recoveries, both through gravity and CIL. One of the things that's come out of the updated pre-feas is the transitional zone. We've got a lot more of it than we thought of before, and we can put that through the plant at 2.4 million tonnes per annum, which obviously gives us a higher ounce production in those first couple of years when payback is so important for debt. Talking about risk minimisation, we've talked about the model, but there's a good slide here in cross-section. One of the things you'll see is we've done very close base drilling at surface. That's 12.5 by 12.5 metre spacing to really get to know this ore body. And you'll notice with that, we've got this big sort of pink purple or pink red area around there. That's higher grade material. And the style of modelling that we've done doesn't allow us to connect that with another high grade drill hole down beneath. It's very short range modelling. But what it does is give us a lot of optimism that as we drill this out in detail, we will see higher grades through this pit. We have talked about the bigger block and how we see that minimising risk. We've also added a ball mill into the circuit to guarantee grind size, but also to allow flexibility to treat other ore sources in the area, not just Klondike. We briefly talked about the single large open pit. That is just the sole focus. The first couple of years we just want to get in there, mine that pit with all our attention on it. It's low strip, it is outcropping at surface, we do know it very well, generate some good cash from that, and then we'll head underground. So we are delaying the underground a few years. We do see the underground being around for a very long time, but we just want to take things sequentially. As we generate cash, we'll use that cash to invest further in our mine life. Recently we secured EPA board recommendation, which is a huge tick for the project. We're now waiting on ministerial consent. That will allow us to apply for operating permits, and we'll have that complete, we believe, in Q4, which will allow us to get on the ground. In the meantime, we can do some limited works when we get our early works permit, which should be through in August or September, and we'd like to finalise the communications, water and village later this year. We have recently gone out for bids on the EPC mining tender, Tails Dam Village, power station. So we're waiting for those responses, and they will form the basis of the definitive feasibility, which will assist in our debt process, and I'll talk about that shortly. Just briefly touching on some of the economics of the project, we're looking at an all-up capital of around $116 million. What does that mean? Well, with an average 1250 Aussie all-in sustaining cost and gold price between 2,500 and 2,600. That generates a lot of cash, and at the moment we see a payback of around 12 months. So really, really strong cash flows, 8-year mine life. You can see that in the free cash flows that are shown on this slide. Solid NPVs, and with an enterprise value of ourselves of just over 100 million, we still see a lot of upside within this. You might note on our gold production slide that ounces drop off after about year 5. That's when we treat those low-grade stockpiles. Certainly with our underground drilling and our regional exploration, we believe that production profile will remain steady, if not grow, at that point, and that's something we'll be working on in the next couple of years. So where are we going from here? Permitting, we've talked about end of Q4. Definitive fees, September, and with that definitive fees we can finalise a short list of financiers. We have gone out to financiers for indicative terms. Once we finish the definitive fees, then the independent expert report, we can get credit approved term sheets, and the idea is to have that ready for drawdown by end of year. The tenders are out. As we've said, they'll form the basis of the DFS. Early works later this year to put all the base infrastructure in. Then we should be on the ground early next year constructing, and assuming we've done our long lead items this year, that's a 10-month construction window, which could see us pouring gold late next year or certainly early the year after. So that's the project and obviously a key focus for us, but exploration is also very important, and there's three parts to our exploration strategy. There's near mine, there's the Warrawoona Regional, and there's, if you like, our Greenfields or Otways project, which we've recently announced an earn-in on. Near mine, we've obviously got those holes that we're drilling beneath the Klondike resource that I mentioned earlier. That's underway. We've also recently flown aeromag, detailed radiometrics. We actually got the data set in yesterday, so the geos are poring over that as we speak, and we'll use that to target just not only the near mine, but the Warrawoona Regional, where we've done some extensive soil sampling. So we have put a place marker in for some drilling later this year. It's up to the geos to work out the priority of targets at the moment. If we look at Otways, this is where a drill rig's heading out in the next couple of weeks. We announced this in the last month, an earn-in. This area is similar style rocks, but is a very big, fertile, mineralised area. We see a lot of stockwork, we see potential of porphyries, they have been mapped out there before. So we're pretty excited about the upside here. And we'll be drilling 2 targets initially, and we'll put out a release on this in the near term, detailing a bit more, but basically there's a cross-section on this slide. This drilling was done in the 60s. Yes, it is copper, but just 200 metres along strike. There's some trenching with some good gold results up to 13 grams. This drilling was never assayed for gold. So we're going to punch in some 200 metre deep holes in this area, assay for everything that moves, and see what comes out of that. 1.5 kilometre along strike from that, Malachite Flats, is actually a big gold lag anomaly. Stockwork, quartz veining, good rock chips. So look out for that announcement. There'll be a lot more detail on that, and that's another area where we'll punch some holes into in the coming month. Just to show that value proposition, in particular the bottom graph I do like a lot. This is free cash flow generated per annum versus enterprise value, and as you can see we're trading at just over 1. Now if you look at the average of producers, they're sitting around 5 to 1. So obviously we need to raise some equity to build, but you can see the uplift as we move into production, and I think you can see that from previous companies in the last year that have headed that way, between West African Resources, Capricorn Minerals, etc. So we're pretty excited about the next 6 to 12 months as we move into production, plus also that exploration work that we're doing on the side. So busy 6 months ahead in particular. We've got feasibility, permitting, drilling, financing, getting ready for construction. So lots to talk about in that time, and we certainly hope you're along for the journey. Thank you very much.
Thank you very much, Dave. We've had a few questions. One question has come in from about the same question from 3 people, is a little bit more about the metallurgy, particularly in the transition zone. Can you shed any light on that?
Yeah, absolutely. The transition metallurgy is better than the fresh. So there is no depletion zone here, there is no laterite zone, it is one solid ore body from surface down. All it really is a softer rock that allows us to put it faster through the mill. Recovery is, I think, about 0.1% better in transitional, but really no difference.
And you ran through some of the PFS numbers there and the economics. Some people might look at those figures and say they're almost too good to be true. Why are the economics particularly good in this case?
Yeah, so I think there's a combination of things. I mean, obviously having an outcropping ore body at surface with a low strip is a fundamental part. It's very cheap milling, as we went through for a variety of factors. That certainly helps. And, it's a reasonably bulk ore body, up to 35, 40 metres wide in parts, so, that certainly assists. And we're in a stunning gold price environment, so, it's a good time to be developing a gold mine.